Let's talk some earnings and some of the analyst notes out this morning. Renita Young, our senior markets correspondent, joining us to take a look firstly at Cisco here, a winner and a much needed one, up 3%. Renita, what's the market like about this?
Well, the company had better than expected earnings. It also touted its AI potential and said that it was able to grab more market share during the quarter. But it gave a disappointing revenue forecast for the fiscal year 2023. But if we take a look at the numbers, adjusted earnings came in at $1.14 above estimates. Revenue grew year over year to $15.2 billion, also above estimates. Margins expanded, expenses also grew during the quarter. And the CEO, Chuck Robbins, said that the company gained more than 3 percentage points of market share in its 3 largest networking markets during the quarter. And he says that he expects the company to gain more in these areas. Now, he touted the AI potential of the company as well, said that Cisco was likely to be a leading supplier of networking gear needed for AI workloads in the near future. But there are still concerns about slower growth, which shows up in the fiscal year 2023 estimate and the share price action. This stock is underperforming the market year to date. It is not up higher than the S&P 500. But if we look ahead, first quarter adjusted earnings is expected to be $1.04 at the high end. Fiscal year adjusted earnings, it's expected to be $4.08 at the high end. Both of those beat analyst estimates, but it's that fiscal year 2024 revenue that came in below analyst estimates. It was $58.2 billion at the high end, but the estimate was for $58.38 billion. Now this morning, of course, analysts are talking. Morningstar downgraded Cisco to a hold from a buy with a $56 price target. Jefferies, however, raised its price target on the stock to $59.50 from $54, maintaining a buy rating. And then Citigroup raised its price target on the stock by $1.
Okay, that's an interesting situation. The analysts kind of at odds a little bit. The stock actually kind of gapping through to a new year-to-date high. This was one that could have kind of been a big leader today, and it's trying to do that, so that's definitely helpful for bulls, even with the kind of lack of surprise on the fiscal year. You know, it's not that it's a big miss or a big disappointment. It's just it seems like they kind of ran out of juice in their forecast for the second half. It's like next quarter, okay, better than expected. Earnings, outlook better than expected, but then for the full year revenue, it kind of sounds like they've kind of run out of ability to hike the guidance a little bit at this point.
Okay, that makes sense.
Yeah. All right, up 4%. Pretty nice little pop. Market's going to love this. I mean, definitely helps to have something going in the right direction tech-wise. Let's flip over to Tapestry after getting blasted on the Capri deal. Now we get the numbers. Is this a company that can handle a big acquisition?
Probably not. That's what some analysts might say as they begin to respond to this earnings report. The company missed in earnings and revenue, and the guidance was weak. It's the parent company of Coach Katespade and Stuart Weitzman, of course. Adjusted earnings missed the Zacks estimate by 1 cent. It came in at 95 cents. Revenue was $1.62 billion, also missing the estimate. And when we break it down with the brands, Coach brought in $1.25 billion. That was the most. Katespade brought in the second most, $309.5 million with an M. Stuart Weitzman brought in just under $63 million. Margins, however, expanded during the quarter, but so did expenses. And looking ahead for the fiscal year 24, Tapestry is expecting revenue around $6.9 billion. That was roughly in line. Earnings at $4.15 a share. At the high end, that was lower than analyst expectations of $4.22 a share.
All right, not exactly a fantastic report for middle of a big deal. I mean, I guess to some degree it kind of speaks to maybe the need for some additional brands, maybe some synergies of business model to free up a little cash flow to the bottom line, given the earnings EPS miss. The sales miss kind of suggests a little boost to revenue from some of the other brands, from Capri, some of the higher end stuff might help. So on that angle, it's like, all right, maybe then the deal makes sense, but as a stock, it does present a challenge on how much they can chew after they bite off a lot from this deal. Market not a big fan of it. We're down about 1%. Thanks for the look at the numbers, Renita. Appreciate it.